Markets are staring down a big week. Housing data, a fresh wave of earnings, and the Kansas City Fed conference in Jackson Hole. It's the kind of setup where one comment from Jerome Powell could rattle the whole market. Welcome back to Navellier Market Buzz. Let's bring back two crowd favorites, Jason Bodner, founder of Money Flows, and Tammy Marshall, the Fibonacci princess. So other than housing numbers, all eyes are on Jackson Hole. Jason, Tammy, what do you expect to hear from Powell?
I expect he's kind of in the crosshairs of Donald Trump. Everybody knows that. Trump is pressuring for his resignation, calling him all sorts of names, insulting him, trying to catch him on that budget thing with the hard hats. So clearly he's under pressure. I don't see him buckling. I see, if anything, him standing firm. But, the good news is it's up for a vote. I think he's going to cite persistent inflation. However, general improvements in the economy warranting a forward, rate cut, hinting at what everybody already has priced in. However, to your point, Crystal, any sort of negative comment, especially in this seasonally, historically weak period of time, could indeed rattle the markets. And I think, just based on volatility we saw last week, outsized earnings overreactions, the market's just looking for a reason to slip and fall on its face. Data that I'm looking at shows money flowing out of the market while the market's still rising. That doesn't always bode well, but that kind of lines up for a weak August and September. So to your point, if he says anything or sneezes the wrong way, we could expect some market shocks, but I think it would be temporary because rate cuts are coming.
Yes, I completely agree with Jason. I've been on some other podcasts this week, and everybody's kind of feeling the same way, that a lot of, even if we get rate cuts, a lot of it could be priced into the market anyway. They're saying that we're going to get rate cuts. There's the 85 to 90% chance at this point. The problem is, though, is it could be priced in. I also pay attention to Jason's work at Money Flows, and that is what I've been noticing when I get their report, is that money is flowing out of the market. So even though we're going up. So I would just be cautious right now.
And I would add that, Powell is definitely a lame duck. Obviously, his speech on the 22nd is important, but he just has a growing minority of members, FOMC members, that want to cut. Trump put on a new Fed official, but when Neil Kashari came out and said he wanted to cut, it was a big deal. And then Mary Daly from San Francisco Fed wants to cut. So I'm counting at least 5 that want to cut now, and those are just the public ones. So I'm sure they'll get a majority and cut in September. And of course, Bassett went on Bloomberg and told him to cut 50 basis points. I don't know if he'll get that, but I should add that the PPI was a little shocking, the Producer Price Index, but there's no tariff data in there, and that was mostly a surge from an 11.8% increase in diesel prices. And I'm in California right now, where there's a bit of a diesel crisis here because they want green diesel in California. So they don't seem to understand when you refine a barrel of oil, you get diesel, jet fuel, kerosene, asphalt, and they want the gas. They just don't want the byproducts. So I don't know where it's going, but the diesel they have here is diesel.
You don't mind, I'm going to throw in a question because we get this question a lot. So actually, a lot of our subscribers have been wondering, if the Fed does cut, then doesn't the US dollar decrease in their value?
Yeah, well, generally speaking, when rates fall, you're right. It should weaken the dollar. However, rates are kind of falling or implied to fall everywhere else in the globe. I think Australia recently voted to cut their rates. Rates are falling in Europe. Rates are falling in China. So we're still a safe haven as far as a currency goes because our rates are elevated compared to the rest of the world. So even if we do get a cut, I think we're still, the dollar is still one of the strongest games in town. But yes, it should fall relative to other currencies.
Yeah, I expect the dollar actually gets mojo back. I think the weakness in the dollar is mainly because a lot of our allies just don't like our president. But the truth of the matter is, long term, the dollar is based on the strength of your economy versus other countries, the size of your deficit, and although ours is big, it's nowhere as bad as Japan, Brazil, and some other countries. So we're looking okay there. And then finally, where your real rates are compared to the rest of the world. And as Jason pointed out, there is falling rates around the globe, and we're the last to cut. So our currency is the reserve currency, and it should dollar should get its mojo back. And we're hoping the dollar's appreciation offsets virtually all of the tariffs.
All right, before we hit next week's earnings calendar, let's check in on a few of that stocks that have been under pressure. Let's start with Eli Lilly. A monster run on weight loss drugs, but is there still some upside, or are we topping out?
I should point out that Lilly slipped to a D in my system, which is normally a sell. But I'm refusing to sell it because their sales are forecasted to be up 40.1%. Earnings are forecasted to be up 437.9%. That's positive balance revisions. And it had a 12.9% earnings surprise last quarter. It went down on the drug trial. They had a GLP-1 drug trial that wasn't very good. So right now my fundamental models are beating my quant models, so I'm going to let the fundamentals overpower this. But a lot of people are really worried about the stock technically, so we'd like to have Jason and Tammy's input on this.
Sure. I can jump out and I'll share my screen here. What we find is that it's really quickly, this is the money falling out of the market. The amber line is big money index while the market is rising. That's what we were talking about earlier. But if we quickly jump in here and we look at Eli Lilly, what we will find right away is this stock is very technically weak. Over here, you can see a technical score of 17.5. Fundamentally, it's very strong, to Louis' point. So, looking at a chart, we've seen a lot of money flows out, a steady downtrend. You had a little pop here, but overall, technically it's weak. Fundamentally, it's really good and strong. Great sales and earnings growth, good profitability. I don't love their debt, but they're a drug manufacturer, so that's sort of implied. And recently it was a top 20 stock, and it's been sort of had the cut off at the knees. So I'm kind of the opinion any sort of positive comments with the prices down here are going to be positive for a stock with such strong fundamentals.
So last time I was on the show, we talked about Lilly, and what I told you was Lilly needs to hold 733, which was the low right before earnings, and I had some support there around 737, and sometimes you have to give it a little wiggle room, but I said it needed to hold that 733, 735 area in order for us to continue the move up, or we were going to make a deeper downside correction, and that is exactly what happened. We did make a deeper downside correction, and now we came down to 623. I said we would take out the previous low of 709, and that's what we did. Not only did we take out that previous low, we took out the previous low from April also. What I'm looking at now, though, what I do like about Lilly, and I do like also what y'all are saying about the fundamentals, because to me, I love technical work, but I am not one of those technical analysis people that says all you need to look at is technicals. I also like looking at fundamentals. My husband's a fundamental guy, so we make a really great duo in our home office here where we work. So coming to a monthly chart, so one of the things that we do see when we see one of these huge pullbacks is we either see a 50% retracement or an 80% retracement. And the 80% is the 786 retracement. Okay, that's about 80%. And what have we pulled back to? We've pulled back to that 80% retracement. And then just under it of another swing, I've got a 50% retracement. So I really like this zone, 550 to 614 on Lilly. I'm actually very interested in this stock now myself, now that I see that we have this price support on the monthly chart.
Some other stocks I own that we're getting a lot of questions on because they pull back, is the big one is probably Supermicro. Obviously, this company has huge order backlog, and their sales are forecast to be up 8.9%. But there have been some recent analyst trims, and their guidance has been really sloppy and uninspiring. The main reason I'm holding Supermicro, we're still 750% in it. We don't pay the capital gains taxes. But we do get a lot of questions on this, so we'd like Jason and Tammy's either reassurance or guidance on this.
Sure. A quick look at SMCI shows it's got, again, I should explain the sweet spot for my scoring is between 70 and 85. That's optimal. So it's just below the sort of optimal range. It's technically a little bit weak, but very strong fundamentals. Again, we're all about money flows here. It's in the name of my research firm. We like to see the greens, money flowing in. That means institutional support, people, unusually piling into the stock. And when you get that over a prolonged period, you start to see stuff like this, these big, huge leaps higher. So we are potentially ramping up, even though sloppy guidance earnings, it looks like sort of a temporary move downward. And again, to Louis and Tammy's point, we look towards fundamentals, and the fundamentals of SMCI are really strong. It's kind of hard to get growth like you've gotten out of SMCI and sustain it for a super long period of time. So the stock gets punished for that. But you're looking at phenomenal 1 and 3 year sales and earnings growth. This didn't populate here, but the 1 year estimated sales growth for SMCI is about 31%. And, 1 year estimated sales growth is about 24.4%. 1 year estimated earnings growth, 30.6%. So despite not being the darling that it once was, still has terrific growth metrics and occupies a really niche business of, making these cloud servers that are optimized green for AI. So, AI is not going anywhere. The hardware components providers are not going anywhere. I still like SMCI, but it might be a bumpy ride for a while. Like Louis, I have big embedded gains that I don't plan on just standing in pain.
Well, as far as my view on SMCI, I actually do like it technically at this point. So the risk is very clearly defined for me. I like this area 40 to 44 because it does include the pink. That pink dotted line is my 200 simple moving average. And on a monthly chart, I see the same pattern. This is what I like to see. I like to see this pattern of where, it goes straight up, then it comes back to a 786, then it takes off again. Now we're having that pattern of higher highs and higher lows. We're just seeing a pullback inside of a larger swing. Okay, so when you zoom in, you get to see that we're still in this larger swing, and we're just having a pullback that defines our risk very clearly. So I really like this zone of risk, 40 to 44. If you are able to risk a wider zone, I would include that symmetry at 30 and make it 30 to 44, because if we take out that 30 area, we will either retest the low from the 7th of April, or we will make a deeper downside correction.
Now let's talk about Sezzle. Buy now, pay later name with a knack for beating expectations, but what do you expect for them?
Well, I should add that their sales are supposed to be up 48.6%. Earnings are forecast to be up 31.5%. They had some recent analyst trims after their last earnings announcement, but it has a very good earnings surprise history. What happened to Sezzle is it looks like it got taken out by the algorithms, because when they announced, they had their net income, which actually dropped slightly because of an extraordinary item, but their operating earnings were 19% better than analyst estimates. And these algorithms just read the newswire, and they didn't have the operating earnings per share in there, and that was unfortunate. And so I think the computers took it out. But let's see if Jason and Tammy think it can recover.
Yeah, I think, first of all, the algos, that's a great point, Louis. Back in 2011, maybe, I had a client when I was at Cantor on the trading desk. I was running derivatives. I had 14 traders working for me. He was asking me, hey, can you send me every email you get in the morning about, you know, information. So on a Wall Street desk, people are, shuttling information in and out. And I was like, dude, that's like 600 emails a day. How are you going to read those? He goes, I'm not going to read those. My computers are going to read those. And they go as inputs into my model. That's almost 15 years ago. So think about how sophisticated things get now. And to Louie's point, these algos just interpret information, they turn it into, a binary on off, and then they act on it. So I'd agree because, if I'm going to share my screen again and we're going to look at Sezzle here, this thing has a phenomenal fundamental score of 79.2. Again, it's very hard to get 100 in my system. Anything above a 70 is really great. Technically, it's weak because it's been punished. This kind of the score makes things very easy as 62.1. This is one that saw great inflows, took off. You can see how that institutional money sort of predicts forward price movement. But now, I would hate to be a company releasing earnings in August because all you have to do is cough and they're going to shoot your stock. But this company has 1 year sales growth of 70%, 1 year earnings growth of 1,000%, 3 year earnings growth 527%. So phenomenal growth. They have a handsome profit margin, 29%. It's fundamentally really good. I mean, the good news about this stock coming down here is that the PE came in. But, to Tammy's earlier point, you sort of have this longer term uptrend. So we got really hyperextended. It pulled back. I think we actually bounced from here, is my opinion.
I like this stock also. It actually has very clearly defined risk on the daily chart. That pink dotted line there again, that's the 200 simple moving average, and it correlates with a cluster of support 75 to 87. So the risk is very clearly defined. If we take out that zone, then I would not feel as good about the stock itself. And this is what I like to see. I really like to see clearly defined risk where all you do is put your stop just underneath that zone. And if it doesn't work, then you have minimized your risk and you can move on to something else that is working.
So my latest embarrassment is Innovative Solutions. This is a company makes all kinds of great aviation equipment for commercial and military. And they just announced that their sales were up 105.2%, operating earnings were up 43.3%. But they have the exact same thing as Sezzle. They had confusion over net income versus operating earnings. And it looks like an algo took the stock out. And I hope it has a big reversal. As I talked to you, it's up in the aftermarket. But what do you guys see here technically? This just happened. So this is a recent incident.
Yeah. So this is one of those stocks that doesn't often appear on my radar. It's sort of a lower liquidity name. Fundamentally, sort of middle of the road, slightly better. Technically, it has weakened. Well, certainly here you can see this big drop from, what was that, 1948 to 1351. So that's the technical weakness to your point, Louis. This one doesn't really register any money signals for me. So that automatically takes me out. It hasn't appeared on my top 20 report of best stocks with unusual accumulation. But if we look into the fundamentals, great sales and earnings growth, nice 15% profit margin. They do have a little bit of debt, fine. They are slated to grow earnings next year 9.8% and sales 20%. So on a fundamental basis, I really do like the stock. For me, I need to see a little more liquidity. But if you're asking what's going to happen technically, I mean, you have this huge move since the beginning of the year, or really rather April. We had this big uptrend. It's still intact. So yeah, you're pulling back significantly, but I think, again, we bounce. I think we go through a volatile summer period, back half of August, September, and I think this stock's going to find its mojo for the fourth quarter.
ISSC for me, I came to a monthly chart because I just wanted to see the bigger picture, and I also wanted to see if I could have some symmetrical projections. So what I mean by that is I'm looking at previous swings in the market that are equal to the swing I'm currently in. And I couldn't see anything on the daily. This was my daily chart. But on the monthly chart, I could see data from a much longer time. And that's why I run so many different time frame charts. I can see all the way back to the high of April of 2007. Okay, and then the low from March of 2020. And I do like the pattern here. I like the way that it looks. We had that low. I have very, very clearly defined risk here. The zone that I'm looking at is about $11, $12. If we were to take that out, then I do think that we could see a much deeper downside correction. But the risk is very clearly defined here. We have a lot of room to run. The target extensions from that larger swing are not until 37 and 46. Those are the green numbers. So I do like this setup because the risk is so clearly defined. And the only issue, let me look at moving averages on the daily. Now, I can still make a case for the bulls because we're still way above that 200 simple. Okay, so if you wanted to risk down to the 200 simple moving average, then I would widen that zone to 9 to 11, or what was it? Let me look back on the monthly. 9 to 12. Okay, so that we could include that 200 simple moving average, because we all know that moving averages by themselves can act as resistance or support. But when I do have it correlating with a zone of Fibonacci, then it also is even a stronger zone for me. So a nice cluster, a moving average. I like that zone a lot, 9 to 12.
Well, I want to thank you guys for reassuring our viewers that good stocks bounce. So this might explain why I don't sell some stocks when they have great fundamentals. So we'll look forward to the bounce. And again, thank you for reassuring our viewers.
Now let's run through some of the big names reporting next week. Let's start with Palo Alto Networks. Just bought CyberArk. Is this a cybersecurity powerhouse in the making?
I would add that Palo Alto Networks sales are supposed to be up 14.3%. Earnings have been revised higher. This has a good earnings surprise history. But this stock has never been as spectacular as CyberArk. So hopefully CyberArk's mojo will rub off on them.
I've always liked Palo Alto Networks. It just hasn't always performed the way I like, but I've always loved CyberArk. If we're going to look at Palo Alto, it's got a middle of the road map score of 56.9. Technically, it's weak. Again, fundamentals strong. We love that because if anything, there's any surprise, this could squeeze to the upside, especially with these outflow signals we were seeing recently. That thing was under heavy pressure, big volume. It is a top-ranked stock. It just never seemed to break out of its range where it wants to go. Short-term, buying a company is dilutive, so investors don't like it. But CyberArk is a great firm. If we quickly take a look at that, CYBR, we're going to see super strong technicals, middle of the road fundamentals, but look at the money flows in, buoying that stock higher. This thing has a strong history of being on the top 20 here in the past, a few years ago before it really caught its mojo. So like Louis said, this could be really accretive to Palo Alto Networks business. It has strong sales and earnings growth. It doesn't really make money, which is not ideal, but that can be sort of absorbed into Palo Alto, and they're obviously going to strip it out for other enhancing businesses in other business lines. So I like the move. I like both stocks. I think it's a good match.
For Palo Alto, from a Fibonacci perspective, it does have all of the moving averages on the side of the bears. However, the risk is very clearly defined. The setup zone is 168 to 73. If we take that out, we will either retest the low from the 7th of August, which is 165, or make a deeper downside correction. Now, I did want to pull up a monthly to see what I see, and we are still looking great on a monthly, honestly. And the zone could be just a little bit wider here, but what we're looking at right now is that we're looking at the swing that we're in, where we came down to that 618. We've bounced to continue the move up. I would, if you're looking to get into Palo Alto, I would use this setup zone 168 to 73. If you are already in it and you're looking to add contracts, that is another great opportunity for you to be able to get bullish on a stock that otherwise does look bearish at the moment.
I would also add for everybody, we need a cyber hack to get everybody excited about Palo Alto Networks. CyberArk's Israeli; they're just better at it than everybody else. And but let's just say Putin and Trump don't get along, and we have an attack. That would be great for Palo Alto. So that's probably more important than their underlying earnings. Let's talk about Home Depot. So their sales are forecast to be up 5%, earnings are forecast to be up 2.2%. They're steady analyst estimates, but they missed the last 2 quarters. And obviously, this is a big retail bellwether. What do you guys think?
Well, yeah, your point. It's a big bellwether stock. It gives indication if people are, spending money on propping up their homes. And it's also highly linked to new home sales. Are people buying new homes or are they fixing up their old ones? From a perspective of whether or not I like the stock, I've held it for years and years. It's not the growth darling it once was, but like you say, Louis, when you have long-term embedded capital gains, you kind of deal with the fleas on an old dog. Fundamentally, it's middle of the road. Technically, it's somewhat strong because we had an inflow signal. That's very encouraging. We like to see these green inflow signals after a period of coming out of a range. We were sort of range bound here for a while after the April pressure. And then, boom, we get an inflow signal. That's actually very bullish. Fundamentals, just kind of whatever. It's a huge cash cow at this point. Sales growth 1 year, 4%. Earnings growth, -1%. They have a 9% profit margin. Next year, they're slated to grow earnings 8.7%, sales 4.2%. This is not going to be a rocket ship. But technically speaking, I like this setup with a new inflow signal. And, if Home Depot can make it through a rocky seasonal period historically, I think it has a good fourth quarter to look forward.
As far as Home Depot from a Fibonacci perspective, it has all the moving averages on the side of the bulls, so it looks great. The larger swing targets are not until way up there at 470 and 509, so we have a lot of room to run. However, with Home Depot, because we've had such a huge pattern of higher highs and higher lows here, my risk is not really as clearly defined as I like for it to be. That is okay. You can still use these levels of support here, but what you're going to want to do is make sure that you're using triggers or indicators to show if the zone is going to hold, and put your stop just underneath whatever support zone you choose. If for some reason it was able to pull back, it did pull back to this 382 area. That is an area I really would like to look at, maybe 380, 382, because it's that 200 simple moving average is correlating with that price support. However, we may not pull back that far. We could just bounce off of this 397 to 99 area and continue that move up to those larger swing targets. And again, those were 470 and 509.
Now let's talk about Lowe's, a rival actually to Home Depot with steadier results. But which one is kind of leaning towards a better buy?
Well, I would add their sales are supposed to be up 1.5%. Their earnings are supposed to be up 3.5%. They have steady analyst estimates and a good surprise history, but Lowe's has been always kind of in the shadows of Home Depot. So let's see what Jason and Tammy think.
Yeah, I kind of feel like it's a lot of the same story here. Fundamentally, right off the bat, this is a middle of the road stock, so I'm not really interested in Lowe's. I get it; it's a bellwether. I get it. It's significant in the home structure. Again, from an inflows and outflows perspective, check this out. We saw outflows range bound. Nothing really happened. We just broke out of this sideways range bound action since April. Looks very similar to Home Depot. We got a few fresh inflows. It's not a top ranked stock because its fundamentals are not great, right? Negative 1 year sales growth, negative 3 year sales growth, earnings growth, and 1 year estimated earnings growth is mediocre. I like to see 10% or better. 3 year I like to see 10% or better, and it makes a profit margin. So this is a fine stock. But to me, there are way better fish in the sea. But from a technical perspective, look, we're getting inflow signals. We're trading near a 12-week high. We're not quite at a 52-week high yet. I really like a 52-week high as a confirmation for a longer-term trend. But, the price is above the 50-day, 100 and 200-day moving averages. It's up. We're seeing inflows. Technically speaking, things are looking good for Lowe's, but I don't love it fundamental.
As far as from a technical, Fibonacci technical perspective, yes, like Jason said, all of the moving averages are on the side of the bulls here. And we do have quite a bit of price support here again, just like we do for Home Depot. The difference is, though, Lowe's has more of an uphill battle. So these red lines that you're looking at, those are places where the move may stop and we may make a deeper downside correction. And the way that I get those is by looking at previous swings and then projecting them from those to look and see, where different places where the move may stop. And on Home Depot, we didn't have as much of that going on, but on Lowe's, we do. We do have larger swing targets of 308 and 336 if the low from the 9th of April stays in place. But I don't like to trade stocks where I'm so closely stuck between support and resistance. But as long as you know and define your risk, then you could get into this stock. But there again too, I have so many different levels of support. You would have to pay attention to where you possibly would see some support there on Lowe's.
Tol Brothers, big beat last quarter in luxury homes, but what do you expect for them?
Well, I would add that their sales are forecasted to be at 4.7. Their earnings are forecasted to decline 1.4. They've had some recent analyst cuts, but that 22.4% surprise last quarter was a shocker. Toll Brothers operates in Reno, where I am a lot, and they got to discount homes to sell them. So I don't know if they can pull it out, another surprise out again. What do you think, Jason?
Yeah, I think these rate headwinds have been real for the home builders. Last year, they were all on fire. They still performed pretty well, but that's a headwind when you have high rates and people aren't buying homes, and the housing market is softening. My mom's trying to sell her house, and all of a sudden, a lot of sellers are popping up. I will say, fundamentally, it's pretty strong. I'd like to see a little better, but that's pretty good, 66.7. Technically, it's on the weak side. However, it's got the wind at its back. Look at all these fresh inflow signals. If they do have any sort of surprise, it's going to be a nice gap higher. This is a stock that's been looking to get its mojo back since last November. On a fundamental side, it's kind of mediocre. I'd like to see more sales and earnings growth, but it's tough to be a growth powerhouse without a super vibrant housing market. It makes a great profit margin and manages its debt levels really well for something like a home builder. Technically, it's been strong. Fresh inflow signals near a 12-week high, not quite at a 52-week high yet. Got a ways to go on that. But again, the price is above the 50, 100, and 200-day moving averages. And, one other thing to look at is short interest. When a stock surprises and there's a lot of short interest, it could squeeze higher. It's not a ton of short interest, but this is a large cap name with a big float. So that's something interesting to keep an eye on as well. But technically, it's looking like it's got a nice road ahead of it.
As far as the stock, for me, it has a lot of room to run. The larger swing targets from the April 9th low are 192 and 220. And like Jason said, we have the moving averages on the side of the bulls. So technically, it does look good. This is a pretty large area of support that I have, though. It's 115 to 29. I'm not familiar with how the stock moves, if that's too large of a zone, but what I like about it is that it includes the 200 simple and the 50 simple moving averages. So if we were to get back underneath then the moving averages would be crossing over to the side of the bears and the stock wouldn't look as good anymore. So I do like that area 115 to 29 as a zone of support on Toll Brothers.
Great. Let's talk about Jack Henry. This is a payment processor. Their sales are forecasted to go up 8%. Earnings are forecast to go up 12.9. They've had steady analyst estimates. They got a good surprise history, but can they keep it up?
Jack Henry. So I really like that payments space, digital payments. Obviously, cash is less and less, but let's just look at it from my money flows perspective. We got an overall score of 39.7. Don't love that. Technically, it's weak, which bodes well for reporting. If they surprise, that's going to be positive for them. And fundamentals, it's better than middle of the road. But look at this technical story. You know, it's broken levels. Sorry, I got to move this screen. It's broken 1-year lows on outflows, which is not a good recipe. You know, so that marks a new downtrend. We're seeing outflows. The last inflows, it failed in, what was that? That was March 7th. Fundamentally, kind of yawn worthy in terms of the growth metrics. It is profitable. I like that. Doesn't have a ton of debt. Great. But I need to see more from the growth. So if they come out, surprise, and show stronger than expected growth metrics, and they show strong guidance, with the weakness here, we can expect a nice jump higher. But if they come in line, or, you know, it's a ho-hum surprise, I expect sort of more of the same below this 160 range. I think it'll eventually recover into the 170s, but in the absence of like really strong guidance and forward-looking statements, I'm not expecting much.
As far as Jack Henry, Fibonacci analysis-wise, the setup zone for me is on the monthly chart. It is 146 to 57. If we take out this area, we will either retest the low from October in 2023 or make a deeper downside correction. I had to come to a monthly because on a daily, it's not looking great. All the moving averages are on the side of the bears, and I wasn't able to find the same sort of support because I could not look at as much data. But like I said, the zone of support, the zone of risk is 146 to 57.
TJX Companies guidance will be key after the retail sales report, but what are we expecting for them?
I would add on retail sales, the big news was the June revision was up. So that's going to cause a GDP adjustment probably. But and 9 of the 13 categories are up, although autos led. So we're still sputtering, but there's hope. But TJX is in a tough place. So let's see what Jason and Tammy think.
Sure. You know, from a retail perspective, I'll tell you they're much better companies for me than TJ Maxx. It scores 60.3. I like 70 or better in all three categories. It doesn't meet any of those technicals or fundamentals. And then we go into inflows. Okay, that's promising. You know, it's looking to break a 52-week high. That is very promising from a technical perspective. We like that. It was a top 20 stock in April and failed to sort of eclipse this May high. Looking to break that there. That is positive. So looking at a 1 year, 3 years sales growth rate of sub 10% is not enticing to me, but it's still positive. Earnings growth as well, positive. They make a profit margin. I mean, this is not a bad company. It's just not a phenomenal company. So again, with sort of the wind at its sails, what I will say is when we finally get rate cuts, the economy, even though we're sputtering, is still vibrant on a comparative basis. CPI only crept up to 2.7%, 20 basis points. And the 60-year history is 3.78. So we're basically at Jerome's targets. Even if he says 2%, we're kind of there. Rates are high. We know they're going to fall. That is going to stimulate the economy, and it should trickle down to retail. This is beneficial for TJ Maxx, but again, I think there are other fish in the sea that I like better. But you know, you could do worse at the same.
As far as the TJ Maxx stock and their group of stores, for me, technically, it looks good. All the moving averages are on the side of the bulls. One of the things that I really like about it is that when I am looking at resistance for the move up, there is none. There is nothing that's going to, except for maybe, retesting the previous high from the 20th of May, which is 135. But I don't have anything in my way. on my way to those target extensions, which are 140 and 145. So the path of least resistance is for us to continue the move up. Here again, though, just like with Home Depot and Lowe's, it's been going straight up for a while. So I do have quite a bit of price support. I do like this area, though, 130 to 32 as an area of risk, because if we were to take that out, I don't have support again until the 128 area, tradable support. So when you're looking at my support, what you want to look for as the most important numbers are the red numbers, because those are previous swings in the market that have already happened. So I like this stock based on what I'm looking at Fibonacci wise.
Target, big miss last quarter, but can they turn it around?
I would add that Target is, it's a sad story. They've had inventory issues. They're losing market share on their grocery business to Walmart. I don't worry about this stock. What do you guys think?
Yeah. Today's list of stocks doesn't really have me excited overall. I like to see high scoring stocks. We're talking all middle of the road. And this kind of points to that whole bell curve thing I think we spoke about a couple of weeks ago, where we're really looking for just the very positive tails. I'm tend to traffic in maybe 100 stocks, 50 stocks out of 6,000. So I'm really picky. Target just, not much to get excited about for me. A cash cow, again, if we're going to look at it on a score basis, scores middle of the road, 44.8. Technically 41.2, fundamental 50. In the absence of everything else, I just move on from there because it doesn't exhibit the qualities that I like. We did see 2 fresh inflow signals, so that's positive. It is kind of uptrending from a miserable April bottom, but then again, so did everything in April. It doesn't appear on my top 20, and that's because of weak fundamentals. They're not growing sales. They're not really growing earnings. They have a very thin profit margin, but obviously they rely on tremendous volume. There's not much to get excited about. I guess they eclipsed the 12-week high. That's good. But the moving averages are not stacked as, the last price is below the 200-day moving average. Stock's down 1 month. I'm just not excited about Target. So yeah, we could sort of drift along higher, but any sort of negative statements, we could take out these April lows. So I'm staying away.
First target for me, looking on a daily here, we do have some pretty nicely defined risk around this 100 to 102 area, because it is correlating with the 50 simple moving average. Which you can see. We do have 3 of the moving averages back on the side of the bulls. Those are the moving averages that I look at least. The green line, we're above it. Okay, that's the 50 simple. The 5 EMA and the 13 EMA. So the 5 is blue, the 13 is red. The 5 is crossed back over the 13. So 3 of the moving averages are on the side of the bulls. The only caution I would give you here is that 200 simple is we're still below it, and it is correlating with price extension from the low from the 1st of August. But the risk is very clearly defined here for me on the daily. I would risk 100 to 102, because if that doesn't hold, then we will retest the low from the 1st of August at 98 or make a deeper downside correction. And if you're looking at a monthly chart and you want a larger zone of risk, that you could look for, if you are already in the stock itself, is 77 to 83. What I do like about this is that here again, you see that we pulled back 80%. We pulled back almost to that 786. So that is what I like to see whenever I see a huge decrease in a stock. I like to see it either pull back on a monthly chart to the 80% or the 50% retracement, and then continue the move up and start to see a pattern of higher highs and higher lows, which is what you're seeing here on the daily chart.
Let's finish up on a much stronger retailer, Walmart. Obviously, they got steady growth, strong revenue. Sales are supposed to be up 3.8%, and earnings are supposed to be up 9.9%. Positive analyst revisions, good earnings price history. I actually own the stock. So let's see what Tammy says about this.
So as far as Walmart is concerned, Walmart does have quite a bit of room to run. You can see the market just opened, so the chart is actually moving now. The larger swing targets are 112 and 121. And much like Target, there is not, or was it Target? No, it was TJ Maxx. There's nothing in our way here as far as we have already gone through the 786 retracement of this swing up. So the path of least resistance is for us to continue this move up. I do have price support for you here, and it is quite a bit of price support. If you could risk down to this 93 area that's correlating with the 200 simple, that would also include the 50 simple. So 93 to 99 would be my setup zone here on Walmart.
Similar thing, Walmart, middle of the road score, technicals, fundamentals. I guess what we do like is it's breaking out to new highs with fresh inflows. This has been a top 20 stock fairly recently. The last time was in April when people were rushing to quality. Decent sales and earnings growth, but obviously Walmart's not going to be a big growth behemoth. Louis and I both love growth stocks, and I'm assuming you've owned it for a while. But technically speaking, it's looking good. I think the good news here, when we're looking at TJ Maxx, when we're looking at Walmart, Lowe's, Home Depot, all these large cap stocks, which kind of got pressured, they're breaking out to the upside with unusual institutional support. So I like that. Any positive comments are going to be tailwinds for these stocks, which is great for the overall market.
Jason, thank you for pointing out that there's a healthy rotation underway into the retail stocks. This week's list of stocks wasn't as exciting as most, but let's talk about one strong tech stock, Intuit. Sales are forecast to go up 17.7. Earnings are forecast to go up 33.6. You got positive analyst revisions, a good earnings surprise history. What do you think about Intuit?
Well, I'm glad you finally got a stock that gets me excited. Full disclosure, I've owned Intuit for years, very large embedded capital gains, so I'm not selling it. That said, it's still showing me the juice. So let's just have a look here. Looking at Intuit quickly, just outside my optimal range of 70 on an overall score. That's because it's technically weak. We'll look into that in a second. Fundamentally very strong. As you mentioned, they're slated to grow sales and earnings. It's got punished technically because of this pullback, but that's sort of a retracement from breaking out to these new highs in July. On fresh inflows, it's seen nothing but inflows since May. It's been a top 20 stock 3 times in the past few months. That is great. So I look at this as just sort of a natural pullback, a good opportunity to buy it. Again, full disclosure, I own it. But when we look at the fundamentals, strong sales growth 1 in 3 years, estimated sales growth 14.4%. 3-year earnings growth is very strong, a very healthy profit margin, manageable debt. I really like it. The PE ratio may be a little bit elevated, but as you well know, Louis, with growth stocks, the PE ratio can fall one of two ways. The price can fall to meet the earnings, or the earnings can grow. And Intuit has a super strong history of growing sales and earnings. Technically, it's looking good as it's trading, near that 12-week high. It did pull back. So I kind of like this as an entry point for that stock, personally.
Wonderful.
Well, Jason, Tammy, always great having you both here. We have such a big week ahead with Jackson Hole housing data and a loaded earnings calendar. So we'll all be watching very closely. If you enjoyed today's breakdown, make sure to like, subscribe, and hit the bell notification so you don't miss the next Market Buzz. And tell us in the comments which earnings report are you watching for next week. We'll see you all after Jackson Hole. Thanks so much, everyone.